To really grasp the difference, let's rewind a bit and peek into the historical context, particularly the traditional floor-based exchanges. Imagine a crowded room, a cacophony of shouts and hand signals. This was the heart of trading for a long time. Within this environment, specific roles evolved to facilitate the buying and selling of securities. Now, picture this. You, an investor, want to buy shares of a particular company. You wouldn't typically walk onto the exchange floor yourself and start shouting out your order. Instead, you'd contact a professional whose job it is to execute that order on your behalf. This professional is your broker. A broker acts as an agent. They are intermediaries who connect buyers and sellers. Their primary responsibility is to represent their clients' interests and execute trades according to their instructions. They don't typically trade for their own account or hold inventory of the securities they deal with. Instead, they earn a commission for their services, a fee charged for each transaction they facilitate. Think of it like a real estate agent. They don't buy and sell houses themselves. They connect people who want to buy with those who want to sell, earning a commission upon successful completion of the deal. Similarly, a stockbroker takes your buy or sell order and finds a matching order on the market. Now, let's step back onto that bustling exchange floor. Amidst the brokers executing client orders, there was another crucial player, the jobber. In some markets, particularly the London Stock Exchange before its electronic transformation, jobbers were central figures. A jobber, unlike a broker, acted as a principal. They traded for their own account, holding an inventory of securities. Their role was to provide liquidity to the market by being willing to buy when there were only sellers and sell when there were only buyers. They essentially made a market in specific securities. Imagine a fruit market where one vendor specializes in, say, apples. They buy apples from farmers and then sell them to individual customers. They hold an inventory of apples, and their profit comes from the difference between the price they buy at and the price they sell at, the spread. A jobber operated in a similar way with stocks. They would quote a bid price, the price they were willing to buy at, and an ask or offer price, the price they were willing to sell at. The difference between the bid and the ask was their profit margin. So, the key distinction here is the capacity in which they operate. Brokers act as agents for their clients, while jobbers act as principals trading for their own profit. Let's break down the core differences further. 1. Acting capacity. This is the most fundamental difference. Asterisk broker acts as an agent for clients. Asterisk jobber acts as a principal trading for their own account. 2. Source of income. How do they make money? Asterisk broker earns commissions on the transactions they facilitate for their clients. Asterisk jobber profits from the spread between the bid and ask prices at which they trade. 3. Inventory holding. Do they hold securities? Asterisk broker typically does not hold an inventory of the securities they trade. They simply match buyers and sellers. Asterisk jobber does hold an inventory of specific securities to facilitate trading. 4. Obligation. What are their primary responsibilities? Asterisk broker to execute client orders efficiently and in the client's best interest. They have a fiduciary duty to their clients. Asterisk jobber to provide liquidity to the market by being ready to buy and sell, thus ensuring continuous trading. 5. Direct interaction with public. Asterisk broker directly interacts with the public, taking their orders. Asterisk jobber historically, in floor-based systems, they primarily interacted with brokers, not directly with the general public. Now, you might be thinking, jobbers sound pretty important. Do they still exist? The landscape of financial markets has undergone a massive transformation with the advent of electronic trading. The traditional image of the crowded exchange floor is largely a thing of the past. Electronic trading platforms have automated the order matching process, significantly reducing the need for human intermediaries acting solely as principals in the traditional jobber sense. The role of providing liquidity is now largely taken over by sophisticated algorithms and market makers. Market makers, the modern-day jobber, sort of. The term jobber isn't as commonly used today, especially in many modern markets. However, the function of providing liquidity hasn't disappeared. Instead, it's largely been taken over by market makers. Market makers are firms or individuals who quote both a buy and a sell price for a particular security, committing to trade at those prices. They are similar to jobbers in that they trade for their own account and profit from the spread. However, they often operate within a more regulated and technologically driven environment. Key differences between traditional jobbers and modern market makers include technology. Market makers heavily rely on sophisticated algorithms and high-speed trading infrastructure. Regulatory framework. Modern market making is often subject to stricter regulatory oversight. Accessibility. While traditional jobbing was often restricted to exchange members, market making can be undertaken by a wider range of entities, subject to exchange rules and regulatory approval. So, while you might not hear the term jobber thrown around as much anymore, understanding their historical role is crucial to appreciating how market liquidity was traditionally provided. The function they served is now largely carried out by market makers, albeit in a more technologically advanced and regulated manner. The broker's enduring role. The role of the broker, on the other hand, remains vital in today's markets. While technology has streamlined the execution process, individual and institutional investors still need intermediaries to access the markets. Modern brokers offer a wide range of services beyond just executing trades. These can include investment advice, providing guidance on which securities to buy or sell, financial planning, helping clients set and achieve their financial goals, research and analysis, offering insights into market trends and individual companies, account management, providing platforms and tools for managing investment portfolios. With that said, thanks for watching, and until next time.